Banks are failing. Is your money safe? In recent months, concerns about the stability of banks have grown as rising interest rates, economic uncertainty, and poor risk management practices have put pressure on the financial system. With billions of dollars vanishing due to bank runs and fears of widespread failures, many are asking, is your money safe? Here's what you need to know in 7 key points to protect your finances. Number 7, bank failures and financial instability. A confluence of internal weaknesses and external economic forces is seriously testing banks' financial soundness. The sharp increase in interest rates, which the Fed has imposed to fight ongoing inflation, is one of the main causes of this instability. For banks, especially those holding long-term, low-yield assets like government bonds or mortgages, higher interest rates make borrowing more expensive. The market value of these assets decreases as interest rates rise, resulting in unrealized losses on bank balance sheets. Poor risk management techniques such as excessive exposure to erratic industries like Bitcoin or commercial real estate, which can see rapid value declines during recessions, make this issue worse. Further straining banks' ability to maintain liquidity and solvency is economic uncertainty, which is fueled by geopolitical tensions, supply chain disruptions, and slowing global growth. This means that if your bank fails, you may experience temporary disruptions in accessing your funds while the FDIC steps in to resolve the situation. Insured deposits up to $250,000 per account type per bank are protected, but the process can be time-consuming and stressful. Uninsured deposits, on the other hand, may be at risk of partial or total loss, depending on the bank's ability to recover its financial position. Number 6, billions of dollars vanishing. Bank runs, in which many depositors take their money all at once out of fear of the bank going bankrupt, are a major factor in the worrying trend of billions of dollars disappearing from banks. Because they use a fractional reserve system, banks only hold a portion of the money that is deposited on hand. The remainder is used for loans, investments, and other financial operations. Banks may have a liquidity crisis if a sizable number of depositors make simultaneous requests for their money and they do not have enough liquid assets to cover these demands. Banks may have to sell assets at a loss in order to raise money, which would further impair their financial standing. This situation is often fueled by panic, misinformation, or loss of confidence in the banking system, which can spread rapidly in the age of social media and instant communication. For you, this could mean delays in accessing your money, even if your deposits are insured. In extreme cases, uninsured depositors, those with balances over $250,000, may face partial or total losses if the bank cannot recover its financial footing. The psychological impact of such events can also lead to broader economic instability, as fear and uncertainty spread throughout the financial system. Number 5, is your money safe? The kind of account you have, the size of your deposits, and the state of your bank's finances are some of the variables that affect how safe your money is. Deposits up to $250,000 per depositor per insured bank are insured by the FDIC for each kind of account ownership, e.g., retirement accounts, joint accounts, and single accounts. This implies that the FDIC will pay you back for insured savings in the event that your bank fails, usually in a matter of days. However, sums over $250,000 are not covered by insurance and could be a danger in the event that the bank collapses. You can distribute your deposits among several banks or account kinds to keep your money inside the insurance limitations and guarantee complete protection. Through the National Credit Union Administration, credit unions provide comparable protection. Additionally, it is critical to confirm your bank's FDIC insurance and to routinely assess its financial standing. Keep an eye out for warning indications such as dwindling stock prices, unfavorable press coverage, or regulatory alerts. To lower risk, think about diversifying your holdings or transferring part of your large, uninsured deposits into safer assets. Number 4. Is it worse than 2008? The collapse of the housing market and the fall of large financial organizations like Lehman Brothers in 2008 caused the financial crisis, which some experts fear could be worse than the present banking crisis. Massive job losses, a worldwide recession, and an extended period of economic recovery were all consequences of the 2008 crisis. Today's situation is equally precarious due to the mix of rising interest rates, excessive inflation, and economic uncertainty. The current scenario, however, is distinct in that it is influenced by various elements, including the swift tightening of monetary policy and the susceptibility of banks to interest rate fluctuations. For instance, a lot of banks have a lot of long-term, low-yield assets that have lost value as interest rates have increased. Their balance sheets now show large unrealized losses. As a result, increasing their vulnerability to failure. This could result in a more difficult economic climate for you, one that includes fewer loan options, falling asset values, and perhaps job losses. It is critical to diversify your investments, lower debt, and accumulate an emergency fund in order to be ready for any economic upheaval. Number 3, rising interest rates. The Federal Reserve has aggressively raised interest rates to combat inflation, which has reached multi-decade highs. While higher interest rates can help curb inflation, they also increase borrowing costs for banks and consumers. For banks, this means higher costs of funding and potential losses on long-term assets, such as government bonds, which lose value as interest rates rise. This can lead to a decline in bank profitability and, in extreme cases, insolvency. For consumers, higher interest rates translate to increased costs for mortgages, credit cards, and other loans. This can reduce disposable income and slow economic growth as consumers cut back on spending. On the positive side, savings accounts and certificates of deposit may offer higher interest rates, providing better returns for savers. However, the overall impact of rising interest rates is a more challenging financial environment for both banks and consumers. It's important to carefully manage your finances during this period, focusing on reducing high-interest debt and taking advantage of higher yields on savings. Number 2, systemic risk. The possibility that a larger financial crisis could be sparked by the failure of one or more institutions is known as systemic risk. Because banks are linked by financial markets, lending, and investments, the failure of one institution may have repercussions for the entire system. For instance, if a big bank collapses, people may lose faith in other banks, which could result in mass withdrawals and more instability. Furthermore, banks are essential for lending money to people and businesses. Thus, their failure can have a negative impact on the economy. This may result in a credit crunch, making it more difficult for people and companies to get loans, which would further impede economic expansion. You should keep an eye on the state of the financial system and take precautions to protect your finances, such as diversifying your investments and keeping an emergency fund, because systemic risk could result in a drop in the value of your investments, restricted access to credit, and even job losses if the crisis turns into a recession. Number 1, what can you do to protect your money? Proactive steps are necessary to safeguard your funds in an unpredictable financial environment. First, disperse your funds among several institutions or account types to make sure your deposits are under the FDIC or NCUA insurance limits. In the case of a bank failure, this will guarantee that all of your deposits are completely safeguarded. Second, think about shifting some of your money to more secure investments that are less susceptible to bank collapses, such treasury bonds, money market accounts, or premium corporate bonds. During uncertain financial times, these assets can help you protect your wealth by acting as a steady store of value. Third, stay away from panic withdrawals because they can worsen a bank's financial issues and damage the financial system as a whole. Instead, keep an eye on news and financial reports to learn about the state of the economy and your bank's finances. Lastly, seek advice from a financial expert to determine your risk and create a thorough plan to protect your funds, particularly if you have sizable uninsured savings or investments. To safeguard your financial future, a financial advisor can guide you through the intricacies of the current economic climate and help you make wise decisions. While the current banking crisis is concerning, most depositors are protected by FDIC insurance. However, it's essential to stay informed, diversify your holdings, and avoid panic. If you liked our video, please hit the like button and subscribe to our YouTube channel.